There's a trade setting up right now in the commodities sector that everyone in the gold and silver world should be paying attention to. And here's the wild part. It's not some niche setup in a tiny corner of the market. It's the kind of positioning shift that can pull trillions of dollars with it. Yes, trillions. Because while most people are still hypnotized by mega cap tech and AI stocks, the real action is starting somewhere else. It's starting in hard assets, in industrial commodities, in metals. And if you're a gold and silver investor, you need to understand this trade because it's the same story you've been watching for years, just showing up through a different door. This is a rotation trade. And it's early. For the last decade, large cap tech and software dominated everything. They became the default destination for global capital. But now we're in the early stages of a meaningful rotation away from that concentration. Capital is moving. And increasingly, it's moving into real assets and industrial commodities. Now, here's what makes this so important for stackers. Hedge funds and mutual funds have not fully caught up yet, meaning we're not late, we're early. Let's do the math. If even 10 to 15% of the capital sitting inside mega cap tech rotates out, we're not talking about billions. We're talking about trillions of dollars. And when that money flows into industrial metals, which have market caps that are a fraction of the size and far less liquidity, the impact gets magnified. A small reallocation into a small pond creates a very big wave. That's the entire trade. And that wave doesn't just lift one metal, it lifts the whole complex: iron, aluminum, zinc, and yes, silver. And I know some people don't like hearing this, but it's true. Silver is still treated like a precious metal by most traders, but silver is also an industrial metal. Solar panels, EV components, electronics. It's part of the industrial metals story, whether people want to admit it or not. But today, I want to focus on the clearest, most immediate expression of this entire rotation: copper. Because copper is the everything metal. Electric vehicles, AI data centers, power grids, all of them run on copper, and right now, the world simply doesn't have enough of it. Let's start with demand. Every EV uses roughly 4 times more copper than a gas-powered car. Wind turbines are copper intensive, solar farms are copper intensive, charging stations are copper intensive. BHP projects global copper demand rises by 70% by 2050. Now add the grid. Governments around the world are spending trillions upgrading aging power grids, and every mile of new transmission line requires copper. Now add AI. Hyperscalers like Microsoft, Amazon, Google, and Meta are collectively spending hundreds of billions in capex this year to build out AI infrastructure, cooling systems, power distribution, power, wiring, copper everywhere. And JP Morgan even said data center demand is an upside risk to their already bullish copper forecast. So we have 3 forces, all structural, all accelerating, all pointing in the same direction. Now look at supply. Copper supply can't just turn on. The average lead time for a new copper mine is nearly 18 years. So even if companies start new projects today, we don't see that supply until the 2040s. Meanwhile, ore grades are declining. Existing mines face disruptions. Peru, the world's 3rd largest producer, has had stagnant output for the last 3 years. And there's more. Glencore is weighing the closure of a major copper smelter in Quebec because environmental upgrade costs have become prohibitive. That's a potential supply subtraction in a market that already needs more supply, not less. JP Morgan projects a global refined copper deficit of 330,000 metric tons in 2026, and that projection assumes that smelter stays online. Now, just for context, copper was up 40% in 2025, its best year since 2009. It's trading around $5.79 per pound. Bank of America is targeting $13,500 per metric ton in 2027, with possible spikes toward $15,000. But here's the part that I think makes this even bigger. Copper is price insensitive for the biggest buyers because if you're building a $20 billion data center campus, the copper cost inside that building is a rounding error. So, do you really think Microsoft or Amazon slows down a $20 billion project because copper went up 50%? No. They'll pay whatever it costs. That's upside that commodity models still struggle to capture. Now, how do you position for this? This is where the trade no one is paying attention to becomes very real. Most people in metals think in simple terms. They buy physical, they hold, they wait, and that's fine. But smart stackers also understand the paper markets. They understand derivatives. They understand how to structure upside exposure before the crowd arrives. One of the easiest ways to get direct exposure is Freeport-McMoRan, ticker FCX. It's the world's largest publicly traded copper company with assets in Indonesia, Arizona, Peru, and Chile. In 2025 alone, FCX generated just under $26 billion in revenue and $2.2 billion in net earnings. That was up 17% year over year. They have about $3.8 billion in cash. Net debt to EBITDA is just 0.5x. Fortress balance sheet. Market cap around 87 billion. And here's what matters. FCX has huge operating leverage to copper prices. The mines are built, the workers are there, the infrastructure is paid for. So when copper rises, that price increase flows straight to the bottom line. And FCX has another tailwind. Their Grasberg facility in Indonesia is also one of the world's richest gold deposits. So you're not just getting copper exposure, you're getting gold exposure too. And there's one more catalyst mentioned. Trump has designated copper a critical mineral and is considering tariffs on refined copper imports. That incentivizes domestic production, and that benefits FCX's U.S. operations. So the big picture is simple. Copper is not just a cyclical trade, it's a structural story. Demand is driven by the energy transition, AI, and grid modernization. Supply cannot keep pace, and the institutional rotation into this space is just beginning. Now, for traders, here's where derivatives come in. Instead of just buying the stock, you can structure an options trade for asymmetric upside. One example is a calendar call spread. You buy longer dated calls for upside exposure, and you sell shorter dated calls against them to reduce cost. For example, buy the May 60 strike call for about 660, sell the March 27th 70 strike call for about 130, and structure it in a ratio like a 4/8. Selling 4 of the March calls, buying 8 of the May calls. With those prices, you spend just under $4,800 on roughly a $5,000 budget. Now look at the payoff examples given. If the March 70s expire worthless and the stock goes to $90 by May expiration, you make about $19,240. A little over a 4-to-1 risk reward. If it really extends and the stock goes to $110 by May expiration, you make over $35,000, about a 7-to-1 risk reward. And even if timing is off, if FCX rallies early and hits around $80 by March expiration, the ratio structure still keeps you profitable. That's what smart derivatives positioning does. So yes, this is a commodities trade, but if you're in gold and silver, it's also your trade, because this is the same hard assets thesis expressed through the industrial metals channel. And if trillions rotate out of mega cap tech and they start flooding into real assets, the metals complex doesn't move slowly, it moves fast. All right, that's the setup. Watch the rotation, watch the copper story, and understand what it means for the entire metal space, including silver. See you in the next one.